Okay, so um, in this week, we're gonna start to talk about credit market imperfection, which is something that we already talked about from the last chapter. So to make sure that everyone can follow this chapter, I need to ask this first. So, any questions from the previous chapter? Any questions? No? Okay. In that case, we're starting about to talk about this. So our learning objectives for this chapter is the first one is we're gonna construct a basic credit market imperfection problem from the consumer with a kinkit budget constraint. Okay, so basically, why it is kinkit is because the borrow interest and the lend um, borrowing and the lending interest rate is gonna be different. Okay, just like the in reality, if you borrow from the say from the bank, you maybe you pay something like a 2% or one point something interest rate, but if you save on the bank, you're not gonna get that high interest. Okay, your saving interest is lower. The difference between these two interest rate is called the interest rate spread, and this spread actually have some meaning or indicates something for the macroeconomic system. So we're gonna talk about that later. But anyway, um, and we're gonna apply this credit market model that's different from the previous model, the one that has perfect um, credit market to deal with the asymmetric information. Okay, and we will show how limited commitment makes collateral important in the credit market model. Okay, basically, what we will show is why there is a interest spread. Okay, why there is a difference between the saving rate and the loaning rate. Okay, so and then we'll show two different social security model or social security plan that usually called pay as you go and the fully funded program. They are the reason why I talk about this is because this is highly tied to our credit market model, and also because this is actually a very important problem for modern society. Because as you know, that such social security problem is very common in most of the world right now, as long as there's a modern economy. Like in Taiwan, it's called the like 劳保健保, actually not 健保, 劳保公保, um, or 国民年金. Those are all social security plan. Okay, so first of all, let's just assume that the lenders and the borrower face different um, interest rate, and the lender's interest rate is lower. Uh, Wait a minute. Oh, okay, here. Okay. The lender is lower. Okay, he's lending money to the bank. This lower, and we call this R1. And the rate that faced by the borrower is called R2, and R2 is greater than R1. Okay. But the government somehow can borrow and lending at the same interest rate. That's called R. Okay, you can think of this like this. So government is a very very big consumer for the bank, right? So for the bank, and also it's highly unlikely that the government cannot pay back the loan. Okay, so their interest rate is lower than yours. It's reasonable, right? So we just assume that for the government, he or she, I mean, it face the same interest rate no matter they are borrowing or lending. Okay, and we will actually show that the Ricardian equivalence that we showed from the last week will not hold in general. Okay, and we'll show why that's the case. Okay, so for R1 that's less than R2, there'll be two cases basically. This is exactly the same budget constraint that I wrote last time, right? Except that I now have a script one, one, one here, and two, two, two here. Okay, and this is for the case when it is a lender. So your current consumption is less than what you uh what you endow with for the current period, right? Remember, y is what you got from the god, and tax is the tax you need to pay, and we don't have the plum here, means that's the current period. So this is what you have initially in period one, and your consumption, if it is less than or equal to, I mean, the equal one just means you don't lend, you don't borrow. Okay, but if it is less than or equal to this amount, that means you must save some money. Your saving is also your lending to the bank, right? And the other case is when your C is greater than Y minus T. So graphically, what that looks like. The way to do this is you can imagine that there are two lines. This line is exactly the same budget constraint that we have from last week with the interest rate R2. And this line is also exactly the same budget constraint I have from last week, except that the rate is, this was R2 and this one is R1. And the way you find the actual budget constraint is you sort of find the lower bound of these two lines, so that this is the let's change a color. This is the actual budget constraint, or this one is your uh, area that is possible to choose. Okay, and another way to look at this is this endowment point. Endowment is y minus t and y plum minus t plum, right? And along this is endowment point is something that you definitely can consume. Okay, no matter what, you can choose not to borrow, not to lending, not to borrow, not to lend. And in that case, obviously you can consume at that point. And along that point, you can choose to be a lender, then you go to this one. You choosing using this line. And the rate is R2. Or you are gonna be a borrower. Sorry, wrong direction. Okay. You'll be a lender, you're going from this direction, and your rate is R1. And you're going to be, this is lender. And if you go this way, you will become a borrower, right? And it's just following different slope, basically. And you can easily draw this budget constraint. Okay. Any question from this graph, or is it clear enough? Okay, I don't see any confusing face, so I assume that's the you guys understand it. So in this case, I mean, the indifference curve is exactly what we had before. We assume it's the same consumer. Okay, so Indifference curve is always the same. What's different is only the budget constraint. Okay, so the Ricardian equivalence, if I state it again for you guys, is that the timing of the taxation doesn't matter, right? If I give you a tax cut in this period, then I will make you pay more tax in the next period, right? Okay, and because of that, it's gonna move along the interest rate of R1. For you, it's just moving along the interest rate of R1. So for this person, initially his budget constraint looks like this. And the optimization point he chooses is E1. And when there is a tax cut, what happened? So originally you consume Y minus T1. Now the tax cut make T1 to be a smaller number T2. So you now, the endowment become Y minus T2, a smaller number. So this one is a higher number, right? So the whole thing is a bigger number. So you go from basically, you move from here to here. This is your new endowment point. But that's not the, this is new endowment level for current period. But next period, you need to pay back. You need to, or the government need to collect more tax in next period to make the budget balance. And basically, that's gonna be T2 times, or the amount that's increase, or the tax amount that increase is going to be the difference between this R1 T1 and T2. So T1 is bigger, right? T1 minus T2 and times 1 plus R1. Because the government can use this interest rate R1 to do lending and borrowing. Remember? Okay, so I'm using R1. So eventually you'll move to this point, E2. That's the new budget. So the new budget constraint looks like this. Okay. And for this consumer, can someone tells me whether this consumer is now better because of this tax cut or worse because of this tax cut, or he's indifferent between with the tax cut or without the tax cut? You can type in the chat. Better, worse, indifferent. Hello. At least choose one. Randomly pick one. Okay? Most people, everybody say better. Let's look at it. So, right. A way to look at this is, see, this is the original budget constraint. This is the new budget constraint. This area is completely a new area that's being created. And this set is also the new, this set is the part that wasn't feasible before the tax cut. And with this tax cut, this one is now feasible, right? It is now feasible. Okay, and I mean, this is basic econ 101. For a consumer, if the feasible set is larger, this person cannot be worse off because he can at least choose the original point, original optimal point. And now he has some new options to choose. It is only possible that he can choose a better point, but not guarantee that he will be better. But in this case, the case that I show from the graph, this person is actually better. Okay, so true, it is better. Why do I say it's not guaranteed? For example, if the preference looks like this, uh, this this looks bad, but I mean, like this, okay, and his optimal point is something like here. Okay, optimal points like here. Then he has some new area, but he's not gonna choose any point like that though on those margin. So basically, what I'm trying to tell you is that, I mean, this person would not move his optimal point, so he's no better off. He's indifferent between the text cut or not. But generally, this text cut in this case show that the text cut is helping the consumer to achieve a higher utility. And actually, this the graph I'm showing on the screen right now shows that it is more than this, right? It can what this person can do is what the government can do even further is that the tax cut can be larger, so that the um, budget constraint looks like this. Then this person will choose to uh, choose this optimal point G, and the indifference curve is pushing even further. Okay, and compared to what we had from last week, this is with the tax cut, your endowment point moved from E1 to E2. But no matter what, it's the same indifference curve. Sorry, the same budget constraint. The budget constraint don't change. Here, this is the original budget constraint, and this is the new budget constraint. So the budget constraint change. Right? What is also very different is that suppose this consumer is we call credit constraint. It means the optimal point is the endowment point. Okay, so he or she saves 0. No saving is neither positive nor negative. And this consumer, you see that this person will spend all his tax cut on current consumption. You see, like I said, the tax cut is basically this amount, right? And your current consumption, because your original optimal point is E1, and now it's E2. So your current period consumption is also changed by the same amount, right? So the entire tax cut is spent on current consumption, right? But in this case, what happened? This is the tax cut amount. But I mean, and I used to, you know, borrow some money and borrow some money and pay back that lending in the future, pay back that borrowing in the future. And now I move to this point, right? And when I move to this point, I just make my borrowing less. I borrow less this period. And borrow less is saving more. So here it is saving that's increase. This is consumption that is increasing. The entire tax cut goes to consumption, and this one goes to saving. Is this clear? Okay. So what is happening here? Why do the tax cut in this case is helping the consumer? It you know, I mean, I don't know about you guys, but my um, sort of understanding of economics from Econ 101 back when I was in undergrad was that government is basically a bad thing, right? And all the tax are distortion tax. Okay. And here, for the government, the tax is exactly the same, but somehow it makes the consumer better off. So somehow government is doing something good. Why is that the case? You see, why is it the case that initially this person cannot go to this point? This point, E2 point, is preferred to E1 point, but somehow is outside my budget constraint. This is something not feasible. And why is it not feasible? Because when I am a borrower, I'm facing the rate R2. This rate is R2 and cannot borrow at the rate R1. If myself can borrow at the rate R1, my budget constraint will be this, right? And if my budget constraint is like that, there's no problem. So the problem comes from the fact that I cannot borrow with a rate R1. But who can do that? The government can do that, right? The government can borrow at the rate R1. So basically what we're seeing here is the government effectively act like a bank. He make a tax cut for the government, for the people. It's like he's lending money for these people. He borrowed the money from the bank and use this money as a tax cut and lend this money to the people. Okay? Two things happen here. One is like I said, it makes the consumer better off. Second thing is, I don't know if you noticed, but the Ricardian equivalence that I talked about from last week will definitely not hold because the tax cut will actually make people different. So everything I said from last week breaks, right? So you might think, okay, in this case, so the tax cut seems to be a good policy, as because we know there are credit market imperfection in the world, right? So the government should do tax cut from this model that I just talked about, right? But you need to notice that tax policy is quite a blunt instrument. What is a blunt instrument? Blunt means it's not sharp. It's very plain. or uh, yeah, plan. Okay, so it is um, so what it mean by blunt instrument is that it is an instrument that treat everyone sort of equally. The policy hit everybody equally. Okay, and like I said, here what I'm drawing is for one person. For this person, it's beneficial. For another people, it might not be beneficial. It just makes it not good, indifferent, right? Like I show you. So it's not really pointing to those people that the government want to help. A similar argument has been made for minimum wage. Okay. Um, everybody know what's minimum wage, right? So minimum wage, one argument for minimum wage is that it helps the poor because the basic logics that only the poor people will receive the um, the minimum wage. They go to the 7-Eleven to work or McDonald's to work, and they receive the minimum wage. So raising the minimum wage is helping those people. But in reality, a lot of teenager from the middle class family, or even rich family, when they were young, they also go to convenience store or fast food chain restaurant. Actually, that's a lot of the people who do that. Most of the people are doing that. Are these kind of people. So if you're trying to help the poor, minimum wage might not hit evenly or very specifically to the poor that you want to help. That's why most economists most economists who are against um, the minimum wage will tell you that you should do something like the like earned income tax or EITC, earned income tax credit. Okay, that's a negative income tax. What it means is if you're poor enough so that your income is lower than some bound, then the government is paying you the tax, not you paying the tax to the government. Okay, so that if you earn more than that lower bound, then you need to pay the government the tax. Okay, that would actually help the poor better. And here, similarly, if you are using a tax policy to do this, because the tax policy must be applied to everybody, right? We do have some different tax rule for different group of people, but basically, the whole country are applying the same tax law. So that's why it is a blunt instrument. So a preferable policy might be those to target particular group of people. Okay. So tax cut will actually makes government spend some money, and this money there are better way to spend this basically. Okay. So now I've shown you that what happened if there is a different interest rate for borrowing and lending. Now I will show you two reasons why this kind of phenomena actually raise. And the two reasons are asymmetric information and limited commitment. What is asymmetric information? That means the borrower or would-be borrower, they know more of their about their own characteristic than the lender. Basically, you go to a bank and you're trying to borrow some money, the bank can ask you to supply some document to prove that you will be able to pay back in the future. But whether you are actually a good person who will pay back the money, there are definitely something more about that you know, but you will not reveal to the bank, right? So that's the asymmetric part of the information. That's like the usual asymmetric model, that information model that we talk in microeconomics, the lemon card market, lemon market or lemon card market. I don't know if you learned that before, but basically that's the so-called second-hand car market. So you're trying to sell a second-hand car, a used car. Obviously, you know more about this car than who's going to buy this car from you, right? You might know that you once hit hit your maybe your garage door or something and make a little dent on your car. It's hard to tell, but and you actually you fix it even, but there used to be a scar on your car, and that's only you know about that. Right? And how do you drive the car? Obviously, only you know about that. But when you sell the car, the buyer won't know about that. Okay. So, and even if you have really good driving habit, so that your car is, then you might try to convince the buyer that, okay, my car is doing very well. My car is really good, in really good shape, really good condition. But someone else who had actually a poor car will want to say the same thing, right? So it's hard for the buyer to distinguish between these two. Same here, similar here, like the bank. And what is limited commitment is that um, the in this world we just assume that the borrower will choose to default. So to ensure that when you default, the government can actually retrieve money back. We usually make something called a collateral. Okay, what is collateral? We'll show later. When you buy a house, for example, there's a home mortgage. That's the collateral. And in your house, sorry, not that's the collateral. The collateral for the home mortgage is gonna be your home. And if you buy a new car and you don't pay the full money, you pay everything in cash. You use a car loan, then your car is the collateral. So that when you cannot pay back the loan, the government, sorry, not the government, the bank can get your house and sell it, or get your car and sell it. That's what is mean by collateral. Okay, so the first one, asymmetric information. Okay, so here the lending is carried out through banks, and um, okay, so these two are sort of the premises that we will eventually get. Okay, let's assume that the deposit rate is R1 and the loan rate is R2, but we don't show the relationship between these two. Okay, we just assume there are different rate, but different numbers, but it could be the case that we eventually get R1 equals R2. Okay, but anyway, so let's assume that it will be the proportion of the borrower who's never gonna default is A, and 1 minus A were those who always default. Default means don't pay back the loan. And the banks cannot tell the good borrowers from the bad ones. That's the asymmetric part. Okay. And all the good borrowers are identical. They borrow the money amount is the capital L. And the bad borrowers want to make sure the bank cannot tell them different from the uh, the good borrowers. So they do the same thing. Okay. So what that means is, let's calculate the average profit for the bank. The profit is going to be, this is the amount that I will receive in the future period. The the amount that each borrower borrow times this interest rate that I will collect and the original money. And A is the proportion of people who will actually pay back this amount. And for the 1 minus A, how much will it get back? It's 0, right? So together, this is this. And the money um that I that I lend out, total is L, and that my cost is this, right? Because no matter how much, no matter the proportion of people I lend out, who will pay back, my opportunity cost will exactly be the amount that I lend out and times the interest rate R1, the borrowing interest rate. So if I, well, I need to borrow this money from other people to lend out this money, right? So my cost that I need to pay those people, to pay other people back, is L times 1 plus R1. So this is this. I see some confused face. Questions? This is cost. This is revenue. Revenue. Right? Type 1 if you understand why this is revenue and this is cost. 2 if you don't understand. We have 26 people and 14 to 13 people reply. Okay. So half of the people either don't understand my questions or they don't know whether they understand or not. Okay. Fine. So nobody said they don't understand. I will just assume that the rest understand. So this is the profit, average profit or expected profit from the firm, from the bank. And you can simplify it as L times A times 1 plus R2 minus 1 plus R1. And if this bank is zero profit, if it is zero profit, you can easily get this. Well, if it is zero profit, the L doesn't matter. Basically, this one need to be 0. Right? If this is 0, I mean, basically means 1 plus R1 equals A times 1 plus R2, right? And you divide the A here and makes the 1 here. R2 becomes 1 plus R1 divided by A minus 1. That's exactly this, right? And remember, A is the percentage who pay back. So that's going to be a number between 0 and 1. So you divide something that's less than 1. This one is going to be actually larger than, this term is going to be larger than 1 plus R2 or R1. So the whole thing minus 1, this whole thing will be greater than 1. That means R2 is greater than R1. When is it the case that R1 will equal R2? The only case that R1 equals R2 is the case where A equals 1. If A is 1, then 1 minus R1 divided by 1, that means you don't divide anything, minus 1, that's R1. Right? So when everybody will pay back the loan, R1 will be R2. R1 can be as high as R2, basically. Or sorry, R2 can be as low as R1. Okay. So the difference between R1 and R2, that's called a default premium. And this premium is increased as the A decrease. If the percentage of people who pay back the loan is lower, then obviously the difference is bigger. Okay. So in those cases, basically, even the good borrower face a higher loan rates, right? Because we assume that everybody is paying the same loan rates. So basically what you see here is that those who are bad borrowers are are hurting those good borrowers as well, not just the bank. They're hurting the good borrower because the bank ex ante, before the next period, they cannot tell the difference between the good borrower and the bad borrowers. Okay. So what will happen on the graph is basically the budget constraint will shift in when the loan rates goes even higher. And in that case, consumption will fall for all borrowers. And this actually matches the observation from the financial crisis. When in the financial crisis, what happened is the credit market uncertainty is higher. More people are not able to pay back the loan, right? So in this will actually what you find is the higher loan rate will happen and decrease in consumption will happen. So what I mean by shift in is basically because this one is not change, right? So what happened is this will become this. The consumption, the borrowing budget part of the budget constraint shift in. So why the consumption is lower? Because if you're a borrower, all the borrower consumption must be lower right now. Because if you're a borrower, that means you used to be consumed at this point. Now you probably will consume here. So your consumption must be lower. And this is the difference between R1 and R2 in the US. Actually, what I'm showing here is the difference between the AAA bound and BAA bound interest rate, but they're usually the same thing or very similar thing. Okay, and you see that the peak of the interest rate spread was the basically this is the Great Depression. This is the last uh, financial crisis. Okay, any questions? Any questions from this model? Okay. If not, we will take a break right now, and we'll come back at 3:30.